I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major semiconductor company. Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. Let me ask you a question. Do you think our world 20 years from now is going to be more or less reliant on technology? Okay, that's a rhetorical question. We already know the answer. And that's why this high quality semiconductor company, which is broadening out across all areas of tech, is poised to continue impressively growing its revenue, profit, and dividend for years to come. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Skyworks Solutions Inc., which appear to be trading at a significant discount today. Skyworks Solutions Inc., stock ticker SWKS, is a semiconductor company focusing on cellular system solutions that enable wireless connectivity. Founded in 1962, Skyworks Solutions is now a $16 billion by market cap tech titan that employs 11,000 people. The company's fiscal year 2021 revenue is broken down geographically as follows: United States 63%, China 19%, Taiwan 8%, South Korea 5%, Europe, Middle East, and Africa 4%, and other Asia Pacific 1%. The investment thesis here is very simple. Our world is increasingly dependent on smartphones and the wireless connectivity, data consumption, and remote productivity they offer to billions of people. Not only do you have increasing dependency, but also increasing content within these phones. Smartphones continue to need more complex tech in order to facilitate higher degrees of functionality. All of that plays right into the hands of Skyworks Solutions. Skyworks Solutions leverages its IP across its product portfolio to make itself an integral part of the global handset value chain. Primary products include power amplifiers, filters, switches, and voltage regulators. Simply put, it would be nigh impossible to manufacture the world's most popular smartphones without the type of products that Skyworks Solutions provides. Moreover, the company is increasing its presence across other applications such as wireless routers, data centers, and automobiles. All of this bodes well for the company's long-term outlook and its ability to grow its revenue, profit, and dividend. Speaking of the dividend, Skyworks Solutions has already increased its dividend for 8 consecutive years. A nice start, especially considering the 5-year dividend growth rate of 14.9%. Double-digit dividend growth doesn't seem to be stopping either. The most recent dividend increase announced only weeks ago came in at 10.7%. With a low payout ratio of only 31.5%, I suspect many more double-digit dividend increases in the years ahead. What's great here is that you're able to pair that high dividend growth rate with the stock's yield of 2.5%. It's not often that you see a yield at this level with a dividend growth rate of this magnitude. Indeed, it's unusual even for this stock. This yield is 100 basis points higher than its own 5-year average. I see very balanced dividend metrics all the way around here. I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5% paired with high single-digit or higher dividend growth. The yield is on the very low end of that range, but the dividend growth is off the charts. There's something to like for just about any dividend growth investor. Looking at business growth, Skyworks Solutions moved its revenue from $1.6 billion in fiscal year 2012 to $5.1 billion in fiscal year 2021. That's a compound annual growth rate of 13.8%. I rarely see revenue compound at a double-digit rate over a long period of time. Tremendous top-line growth here. Meanwhile, earnings per share grew from $1.05 to $8.97 over this period, which is a compound annual growth rate of 26.9%. Wow, bottom line growth is even more impressive than top line growth. These are truly terrific growth rates. A mixture of pronounced margin expansion and share buybacks help to drive a lot of the excess bottom line growth. For perspective on the latter point, the outstanding share count has been reduced by 13% over the last decade. Looking forward, CFRA is forecasting that Skyworks Solutions will compound its earnings per share at an annual rate of 22% over the next
next 3 years. So CFRA is expecting the next few years to look a lot like the last 10 years. I imagine that'll bring a smile to a shareholder's face. CFRA notes that Skyworks Solutions has benefited from 5G uptake, which led to greater RF content in handsets. However, CFRA is a bit cautious on the story moving forward, and I quote, although mobile has benefited from the shift to 5G by smartphone makers, higher RF content, upside ahead is seen as being more incremental, unquote. On the other hand, CFRA rightly points out its enthusiasm about something I touched on earlier, which is Skyworks Solutions has broadened itself out. Again, and I quote, we remain optimistic about prospects in Skyworks Solutions broad markets up 38% on greater penetration in faster growing end markets, including automotive, industrial, data center, and network infrastructure, unquote. I see this as a very wise move by Skyworks Solutions. Its Achilles heel has long been its heavy reliance on handsets in general and Apple Inc., stock ticker AAPL, in particular. Indeed, Skyworks Solutions reported that sales to Apple comprised nearly 60% of last fiscal year's revenue. That is a very high amount of customer concentration. Skyworks Solutions is parlaying its prior successes with Apple into other lucrative opportunities, which fortifies the entire business. If the company is able to come anywhere close to CFRA's earnings per share growth projection over the coming years, that bodes extremely well for the size of dividend raises. With a low payout ratio, the dividend could easily continue to grow at a double-digit rate for many more years. Pairing that kind of dividend growth with the 2.5% starting yield is one of the more compelling combinations of yield and growth that I've run across. Moving over to the balance sheet, Skyworks Solutions has an outstanding financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is north of 33. Profitability is extremely robust, and this profitability has only improved of late. Over the last 5 years, the firm has average annual net margin of 25.9% and annual return on equity of 24.4%. Circling back around to the net margin expansion I touched on earlier, annual net margin was routinely under 20% a decade ago. This is an exceptional business. I see nothing but excellent fundamentals across the board. And the company is protected by durable competitive advantages that include economies of scale, IP, R&D, and technological know-how. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. I see customer concentration as the biggest risk. Skyworks Solutions is heavily reliant on sales to Apple. Any negative changes to this relationship could be detrimental to the business. 5G adoption has largely already played out, leaving the company with less near-term growth from this opportunity. The company is taking steps to diversify the business, but these steps add uncertainty and execution risks. The strong dollar adds near-term currency exchange challenges. Kinks in the global supply chain could weigh on the business. There are geopolitical risks, as China is the company's second largest geographic area of revenue. Lastly, the very business model is a risk. The company must stay ahead of the tech curve in order to not get left behind. I do see these risks as higher than average, but the stock's valuation is also well below average. After seeing its price get cut nearly in half, the stock's valuation is now as attractive as I've ever seen it. The price-earnings ratio is sitting at 12.7. This is quite a bit lower than the broader market's earnings multiple. It's also measurably lower than its own 5-year average of 20.1. For a company that has compounded its earnings per share at 26.9% annually for the last decade, a PE ratio of 12.7 is absurd. That leaves us with a PEG ratio of about 0.5. The price-to-cash flow ratio of 10.4 is also way off of its own 5-year average of 14.3, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is as high as I'll go, but this company deserves the designation. Keep in mind, this is a company that has grown its earnings per share at a rate of approximately 27% over the last decade, and it's expected to do something similar over the next few years. Its dividend growth rate over the last 5 years is almost double where I'm at in this model. Plus, the payout ratio remains low. Skyworks Solutions could easily power the dividend well beyond this 8% growth rate over the next few years, but growth may very well moderate beyond that point. I do like to err on the side of caution, but this is actually a pretty conservative number for this business. The dividend discount model analysis gives me a fair value of $133.92. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Skyworks Solutions as a 5-star stock with a fair value estimate of $180. CFRA rates Skyworks Solutions as a 3-star hold with a 12-month target price of $122. I came out fairly close to where CFRA is at here, but we all generally agree that the stock looks cheap. Averaging the three numbers out gives us a final valuation of $145.31, which would indicate the stock is possibly 45% undervalued. Here's the bottom line, guys. Skyworks Solutions Inc. is a fantastic business with excellent fundamentals across the board, and they've taken wise steps to broaden out the business and make it even better. With a market-beating yield, double-digit dividend growth, a low payout ratio, nearly 10 consecutive years of dividend raises, and the potential that shares are 45% undervalued. This could be one of the best combinations of quality and value in the whole market for long-term dividend growth investors. And now for a special news announcement. Comcast Corporation, stock ticker CMCSA, just announced a doozy. The company is expanding its share repurchase authorization to a total of $20 billion. That's almost 7% of the market cap of the entire company. We covered Comcast in late July, valuing the business at $57.77 a share. This dividend growth stock looks shockingly cheap right now, and the company buying back shares hand over fist at shockingly cheap levels sounds like a great idea to me. Don't forget about Comcast.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.